You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, you know what that music means. It is time once again for Volatility Views, the premier program for volatility traders, your weekly dose, your weekly insight into the world of volatility and volatility trading. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding Options Insider Radio Network. More programs coming down the pike for you guys, but while you wait for them, you can enjoy the 13 existing programs on the network covering pretty much every slice of the derivatives and options pie. If you're a futures options guy, we got a couple shows for you. If you're into some basic options education, we got a few programs for you. If you're more on the active retail side, you want to dive into some trading ideas and strategies, things like that, we've got some programs for you. If you're a financial advisor and want to learn more about options, we have programs for you. And of course, if you're a diehard volatility guy, we've got a show for you called Volatility Views. I'm sure I've forgotten a few in there somewhere. Oh yes, trading tech talk for the technology-minded amongst you, all different facets of the options pie. Breaking news from the options world, we have you covered there as well. No shortage of different topics for you guys to check out. Of course, you can find all of that great content in a myriad of different outlets, including the mothership, theoptionsinsider.com, from whence all of this goodness flows. And you can surf on over there. And if you haven't done so in a while, check it out. We've made some tweaks to the site, changed the layout a little bit, added a little bit more visual pizzazz to the posts to make you guys happy. And of course, you can check out all the content there that we talk about in these shows, as well as a lot more we don't have time to get to, including breaking news from the options market, analysis, education, unusual activity. All you guys love the unusual activity. We have a bunch of that there. We were really very early movers on the unusual activity tip over here at Options Insider, and it continues to be a big pillar of our content going forward. And of course, you can also find that content that we produce on the radio side there on iTunes, Stitcher, Aha Mobile, and of course our mobile app, available for iOS, Android, and the Fire OS. No shortage of ways for you guys to check out our content, and of course to get in touch with us here on the old program too. We love to hear from you guys, hear your questions, your comments, your feedback, so don't be shy. Let us know. I know a few of you guys did just that. We'll get to that a little bit later in the show. But first, let me introduce my cohort here, my partner in crime, beaming in from that hotbed, that mecca of trading activity, beaming in hot from the desk today. He is none other than Mr. Jared Woodard from BGC Partners. Jared, welcome back to the show, sir.
Mark, I'm really happy to be with you today.
I love it. You can hear the maelstrom, the cacophony going on behind him, listeners. It's a pretty quiet day, and yet BGC clearly lighting it up today.
All day, every day, man.
You guys are just slinging it old school on the phone, high touch. I like it.
You know, some people, we do some electronic stuff too, but, for clients who really need to get things done, that's where we work.
You know, when you need that 1/6/3 ratio Condor swap in SPX, Who are you going to call but BGC Partners, right?
Absolutely.
I used to hate your clients, by the way, when they would come down to the pit with their ridiculous quotes that were clearly designed just to pick us off and or get our prices. I used to love doing that because it was just free price discovery for everyone, and it was a joy for all involved.
Yeah. These days, people seem a little bit more circumspect and seem kind of guarded about the really choice quotes. But you know, we help however we can.
You know, when the phone rings from certain brokers that you're just going to go wide because it's some other trader trying to pick you off or just get your straddles or whatever the case may be. You know, so you know to avoid them like the plague. But speaking of things we don't avoid like the plague, we love vol. We're going to dive right into it. It's time to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, that fun little tune means it is time for the Volatility Review. If you're just joining us for the first time, then first off, where you been? It's been going on for 3 years, but we'll welcome you nonetheless. Welcome to the Vol Views family. This is indeed, like the name implies, the portion of the show where we break down the week that was from a volatility trading perspective. We are recording this on Friday, November 14th, for those of you playing the home game listeners. And it's a relatively tranquil session, first off. Most of the major indices pretty much unched on the day. The Q's catching a little bit of a bid, a fractional bid, but not much. Everything else pretty much unched, including the VIX Cash, all kind of just sitting there waiting for the old weekend to arrive. And it's pretty much been that story for the better part of the week as well. It wasn't really the most tumultuous week from a volatility perspective, certainly. We've, of course, just coming off the heels of Rocktober. I hate that term, but it certainly applies this year. We saw a lot of movement, a lot of action, a lot of volatility, and vol in the month of October. Not so much here in the month of November, at least not yet. This week, like I said, pretty tranquil. We saw VIX Cash having a relatively tranquil range this week as well, certainly compared to what we saw a few weeks or a month or so, which is this week had a range of a little bit south of 12.5 on the downside earlier in the week and a little bit almost in the range of 14.5 on the upside. And that was pretty much the story of the week encapsulated right there. Things were kind of tranquilly drifting one way or the other. We're kind of on the tail end of earnings season. We had a few coming out earlier this week, and that's pretty much it for the large names. There are a few stragglers here or there, but really, I believe Home Depot is coming out later, I believe next week. So there's a few names like that I still have to straggle in. But other than that, there aren't a lot of those big market-moving type events that could really send us into a tizzy one way or the other. So who knows? Maybe we'll be in this tranquil mode for the foreseeable future. But before we get to our prognostication, Jared, why don't you tell us what caught your eye and give us your view on the week that was from a volatility perspective?
Yeah, I think that one of the interesting things about this market has been the relative bid that we've seen in premiums in a couple places. Even though stocks have recovered overall, there's a couple spots that I think remain kind of expensive. For example, the trading activity yesterday, the market move in the underlying equity indexes was pretty tame, but we saw the VIX actually up on the day. We saw a pretty big rally in implied vol, in fact. And this fits in nicely with the sense that I think a lot of the premiums that really got put into the market in October haven't entirely come out yet. I think Sebastian and I were talking about this last week, in fact, that even when you've seen stocks rally, you haven't seen VIX levels, you haven't seen implied volatility levels decline to comparable points, looking at where they were with the market at recent highs from before the October decline. And that's definitely true around the world as well. Premiums in options on Chinese stocks, on Chinese ETFs, and even on the big Chinese indexes, all look relatively expensive when you factor in the relatively tame levels of realized volatility in those names. So even though in a lot of these cases around the world, the economic story is flat to positive, there's situations where investors just aren't offering premium. They're not selling down risk the way that they might have done in previous months. So I think that reflects a little bit more risk aversion on the part of investors, and this kind of fits in with our look for the year ahead, which I'm just kind of putting together, which is that I think you're going to see more reactivity to these kind of events. You're going to see a higher, stickier kind of a bid in a lot of different places, and so far that's kind of what we're seeing this week. But it is tempting to get to fast forward to prognostication. But one other thing that I'll mention in terms of looking backwards, the move in oil has just been incredible. I think that this is one of the most interesting stories of the quarter so far. And one thing that caught my eye this week is that even though oil has continued to decline, and there was a big guessing game on Twitter the other day among a lot of finance folks about what the lowest touch would be in the December oil contract. My bid, I think, is already blown out. So who knows where it's going to go. But what caught my eye this week was that energy stocks, if you look at the ticker XLE for the energy sector ETF, they actually have found some support and have held up fairly well, even as oil moves to new lows. And you're seeing the same kind of activity in the options market as well. Implied volatility in XLE and in a lot of the individual energy names has remained pretty high, certainly in proportion to, say, SPY or SPX volatility, implied volatility, I should say. And so that tells you there's still quite a big sense of risk aversion in energy stocks, even though if you look at a price comparison of how the stocks are performing price-wise versus the continued decline in oil, it seems like maybe investors might be a little bit more positive. So that may be an opportunity to take advantage of. It's certainly something that caught my eye this week. And I think that watching these energy names is going to be an interesting story, really through the end of the year at least.
You're certainly right. There has been a lot of activity on the oil and energy sector, and we'll certainly get to that. I think probably, who knows, maybe going forward, even by the end of this year, it might be time to launch Oil Volatility Weekly or Energy Volatility Weekly, because there's so much cooking out there, and we'll certainly get to that. I want to get to that in a little bit. And we have seen, you're right, commensurate options activity as well, reflecting some perhaps change of sentiment out there, including we saw some paper this morning, even people specking to the upside in some natural gas names and others pretty heavily. So it is some interesting paper out there to discuss. But before we get into that, let's keep going on the old VIX train as we are wont to do here. And you mentioned that kind of recurring refrain that was popular this week of, the market rallies and the VIX rallies. And you're right. If you know anything about those products, that reflects a market increase in actual volatility. But I was actually interested as well. It caught my eye a number of times that it seems like some of the broader outlets are getting a little bit more savvy when it comes to their handling of VIX and their coverage of it. Maybe because they beat that drum so many times now. They at least know as much as when the underlying rallies, VIX should decrease, all other things being equal. So I saw a number of stories on some broader outlets this week trying to dive into that a little bit. Why is the VIX also rallying when the market is rallying, and perhaps exploring some structural issues that could be at the root of that. And so that, I think, is interesting if they are actually taking a little bit deeper dive, taking a little bit more sophisticated perspective than, this is the fair gauge, this indicates X amount of fair, and then move on to the next story. A lot of them didn't really get into the notion of what you were just talking about, how, as underlying rallies, VIX increase actually reflects a market increase in overall volatility, and how it defies what should be going on from a skew perspective and everything else. But still, it's interesting to see them thinking along those lines. So perhaps we're seeing a little bit more sophistication coming out of some of the outlets as they cover this type of topic. In terms of what's cooking out there in VIX options land, it wasn't like I said, the most active week of all from a trading perspective. Certainly, again, nothing compared to what we saw over, certainly in October, where we were pushing over 1 million several times that month. This past week, I believe the highest VIX options got from overall volume perspective was on Monday. Yeah, Monday, when it hit about 450,000 contracts. So that's well off. That's less than half of what it was doing at the height of the madness. And there were some sessions this week when we got into, into the south of 400,000 contracts level. On par to do, looks like about that level today. We've done about 270,000 contracts so far today. So if all things hold true, maybe it'll hit 500,000 today. But not the most stellar week from an options volume perspective either. in terms of what was lighting up the tape, in terms of what people were piling into the hot strikes for this week. Nove 20s, surprise, surprise, once again, topping the list, about 330,000 contracts open there. Relatively slight change from last time, too, which is kind of interesting. It seems like that flat 20 round level, for whatever reason, is very intriguing to a lot of people. They love to pile in there. Keeping that theme alive, the Jan 20s, also very popular. Number 2, 227,000 contracts open there. So a sharp 100,000 contract drop from the number 1 to the number 2 slots, which is also kind of interesting. Then we move down to, yet again, the stalwarts, the D's 13 puts, holding the number 3 spot with 222,000 contracts. Then the Nove 17 calls and Nove 25 calls with about 211,000 respectively each. Then the Nove 21s with 180,000 down to number 7. D's 25 is a little bit longer term, a little bit farther out of the money. 170,000 open on that strike, followed by the Nove 22s at number 8, 165,000. And then some other puts, 2 puts on the list this week, which is interesting. The Nove 14 puts, 157,000 contracts open there, so about 70,000 or so less than the D's 13 puts, which have been on the list for quite a while. That strike is clearly attractive to a wide variety of people. And the D's 20 calls round out the top 10. Not as popular as their counterparts, certainly the Nove 20s and even the Jan 20s, only about 155,000 open on that strike. So about 170,000 less than the Nove 20s and about 70,000 less than the Jan 20s. So D's 20s not getting the love for whatever reason. Overall, about 7.35 million contracts outstanding on VIX options these days, a little over 5 of that coming in the calls and about 2.25 coming in the puts. So the call to put ratio lessening a bit as we've discussed on recent shows as well. A lot of that doing to the structural movements of VIX, even though VIX Cash has trended back down toward the lower end of that range. So we'll see if that number starts to tick up. VIX Cash on the open interest from a call put perspective hovering about 2.3 to 1 right now. Certainly well off the highs of the 4.5, 4.6 to 1 we saw a little while ago. Looking at the broader S&P as well, and looking at what's going on out there in skew land, we like to check in with the CBOE skew index every now and then, see what's cooking out there. And we're not seeing, even though the market is rallying fairly substantially, we're seeing a decent level of increase in the old skew index, indicating perhaps some interest, some increased vol, some increased premium to those downside S&P puts, but nowhere near the levels of what we saw in the mid to high 130s back in the October timeframe. We're trading about a 129 right now, which is still fairly high, certainly compared to what we've been seeing of late, where just a week ago or so we were trading around 125 or so. So there has been an uptick in some interest to the downside in terms of hedging, which you probably would expect given the pronounced rally we've seen and us blowing through the 2,000 strike in the S&P, which is a very large resistance level a lot of people had on their mind. So given the fact that we are pushing these lofty highs, it doesn't surprise me to see that we're ticking up a little bit there in the old skew index. Perhaps some people might even think we should have ticked up more. Mr. Jared, does any of that come as a surprise to you, either the VIX options data or perhaps what we're seeing out there in skew land right now? Is that pretty much in line with what you expected?
You know, I think it's consistent with what we were saying before, that investors haven't been reacting in terms of selling skew, putting on collars the way that I think we would have seen given a similar market move, let's say 6 months ago. Some of this is anecdotal and qualitative, but I think if you do look at skew numbers relative to price movement, we're not seeing people, selling the call wing, putting on puts or put spreads in the same way that they've done in recent years. I think there's just, at the margin, a little bit more risk aversion. And so I think that's showing up in some of these numbers. That said, one of the things that I think has also happened a lot in the last weeks is investors putting on some fairly sophisticated VIX spreads to take advantage of not as much premium in the S&P, but the call implied vol in VIX land, reflecting a view, or at least implying a view, not so much that the market's not going to decline further or see some kind of a dip again, but that the scale, the scope of that any such decline is going to be a little bit reduced. I think is the thing to take away from that. And all anecdotally, there's a calendar issue as well, which is just that managers who've had a successful year, who are relatively satisfied with the performance, don't have a lot to gain from a really big risk taking into the end of the year. That's something that people talk about a lot with regard to equity allocation, but I think it can hold true in the options market as well. There's no reason to take on extra tail risk or become more aggressive in terms of what you do for premium if it's not really necessary. And given the kind of the year that the S&P 500 has had, and that the Russell 2000 has had, for that matter, it could just be that people are less interested in reaching for premium.
That would certainly make sense. I'm looking here while you're chatting just at some of the time series data coming out of the skew index, and looking at that big date in October 15th, when, of course, we had that big pronounced sell-off, a lot of volume going up that day. Skew index got down as far as 111 that day, which is kind of interesting. Even though if you know anything about skew, it's not that surprising, but it still is interesting to see all those puts coming into action, and the skew index ticking off quite a bit. It's kind of the one aberration, the outlier point in that data set, when the rest of the month was probably more north of 130 for a lot of it there. So interesting stuff here. We don't talk about the skew index as much because I know a lot of people view it as kind of obtuse, and I can certainly see their reasoning that is kind of quoted in a little bit of a kind of inverse methodology. But if you can wrap your head around that, it is an interesting indicator nonetheless. Let's move on to another product that's kind of been a little bit befuddling of late on the volatility spectrum. This is our kind of the markets and our, on this show as well, kind of on again, off again love affair with all things short-term, including short-term volatility, and that is embodied these days by the old VXST. And this has kind of been a weird one. We talked about it for a while. Will they, won't they? Will they trade it? Won't they trade it? Will they trade it? Won't they trade it? Well, it seems like this week they flipped a switch on the old they will trade it, at least to the tune of some decent volume. That also carried over from last week. I'm not sure how much you guys had a chance to chat about it last week, Jared. I was, of course, running around at various conferences here in Chicago and wasn't able to join you on the program. But last week, going into Friday and Thursday, we saw some very, very aggressive days. This is the product that some days will do 50 contracts, and they did 3,600 last Thursday, I should say, about 3,000 last Friday. And coming into this week, had another couple of robust days, 2,000 going up on Tuesday on the VXST, and then 1,500 going up so far again today. So a fairly robust week, all things considered. Again, all that action today in the calls, 1,400 in the calls, only 100 in the puts. Open interest, about 11,000 contracts now. So that's fairly substantial. That's well beyond the few thousand level we've been talking about for a significant amount of time. So clearly, people are starting to see perhaps a use case for this product. For whatever reason, maybe the vacillations of October awakened them to the near-term vol that they had out in the market, and so maybe this product became more attractive, or I don't know what triggered them to dive into it, but clearly it seems like this past couple of weeks they have been doing it en masse, as they say. And looking here at what the hot positions out here, the hot strikes where people are playing out here in VXST land, it is the 20 calls, yet again, that strike is just the strike du jour for everybody. The 20 calls on the December 3rd cycle here, 3,005 open on that strike. So that clearly is where all the love, all the action is. It's like 1,000 of the NOV 19s are open as well. And then 1,000 of the NOV 14 half puts. One of those is on the NOV 19 cycle. One of those is on the 26th of November cycle. So bear that in mind. Then they kind of drop off from there. About 1,000 of the 18 calls in November as well on that 19th cycle. And then 500 and so on down the line. But still, it is interesting to see people are actually putting in some fairly substantial amounts of paper to the tune of 3,005 of those D's 20s. That is far and away the largest position we've seen going up out there. And interesting, we'll have to keep an eye on that one to see kind of how that plays out and what they're going for today. Today's big trade, I should mention as well, the 1,000 lot we saw going up was on the D's 15s, also on the December 3rd cycle there. So bear that in mind. 4 contracts open there, going up 1,000 times today. Does that surprise you at all, Jared, that this product seems to be catching a little bit of life? I know you and I have discussed on the show many times, what will that catalyst be? Will it have to be some sort of semantic or seismic shift in the marketplace to really cause people to start piling into that? And maybe it seems like maybe October was that catalyst, and people now are starting to see a use case for nearer-term hedging, nearer-term speculation.
Yeah, I mean, some of the uses are pretty unexpected, at least to me. I know there was a trade earlier this week, I think it was on Tuesday, where the December 10.5 puts about 500 of those went up. And if I remember, I think they traded on the bid for 5 cents. And I'm not going to criticize somebody's position, but it's just not something I would have expected to see. If you said, Jared, what are we going to see in VXST this week? You told me someone's going to sell, those far downside puts for a nickel. I suppose there's worse things you can do. But so I agree with your original assessment at the top that this is a product that has developed a kind of an interesting life, and it continues to surprise us. So I think that's much better than a product that does absolutely nothing. And I wonder whether people have been digging into the guts of the index and the way that it moves relative to the rest of the very front of the curve. I think you have to have some really strong sense of what you're trying to accomplish and where you think the world should be to have a view precise enough to trade for a product that is this sensitive. I mean, I have a number of colleagues and friends who trade volatility products, and some of them aren't even equity or volatility specialists. They just like VIX products. They trade carry and roll down type things in the 4th or 5th or 6th month in the VIX futures because, they know that they don't have, and these are professionals, they know they don't have an edge in the very front of the curve. There's just so much noise and movement that in their view anyway, it makes sense to act in products that are a little bit further back. If you juxtapose that with these VXST trades, I think that anyone who's transacting in any meaningful volume in the product has to have some kind of a outlook that would justify and would motivate them to do that. And so I think that's interesting because if someone has that strong of a view at such a short-term product, then more power to them, I suppose.
Yeah, it is certainly an interesting one. And you're right. From our selfish perspective here on this show, if we're looking for content, a product that is a bit of a mystery is always a little bit intriguing. And VXST certainly fills that bill these days. Yeah, blasting out 500 penny or puts for a nickel. I've seen crazier things on the floor, people trading for smaller increments than that. But still, you're right. That is a bit of a head scratcher as well. And who knows if they're attracting that crowd, then perhaps something else is amiss there. But it is interesting to see something clearly has awakened people to this product. Maybe it was the way it interplayed with the quote-unquote big VIX during the tumult of last month, or something along those lines seems to have triggered people to start saying, hey, this is worth exploring a little bit more. We'll see if this is, I mean, it's still not a home run by any means. There were still some days this week where they were putting up 200 contracts a day. So it's not a 2,000 contract a day monster, but it has its moments, which is kind of interesting. Before we migrate away from the ever-expanding VIX-related suite, I think the big story of the recent weeks from the VIX land, of course, is they're adding yet another product to that realm that is, of course, coming in on their heels of all the talk about the treasuries and the volatility out there. They, of course, have their Treasury note VIX, the 10-year, and they've just launched some futures on that, at least according to the initial days of volume coming out from last Thursday when they launched them. I think they did a whopping 0 contracts. But again, like we saw with VXST, these things could surprise us over time. I know we touched on this a little bit before, Jared, but now that they're actually launched and in the marketplace, what's your take on this foray into a Treasury-related VIX? I think this has some legs, or is this yet another VIX-related product that they're going to launch to a lot of fanfare, then it kind of goes away?
I really hope that this succeeds. I'm pretty excited about this product, honestly. And if I was trading on the buy side, I think I'd probably be looking to get into something on one side or the other, because I think this is a really interesting, innovative, at least innovative in the sense of at the level of asset classes. I mean, we have so many equity volatility products. If you want to trade in interest rates, trade vol in interest rates. I mean, there's so much more complexity to the whole asset class that I think it's been hard for people to find the right product, both in terms of which maturities to target, and is the VIX methodology the right one? But I think that the CBOE and the CBOT together have something here that could really work. So in terms of outlooks, who knows whether it'll be adopted. I know that a lot of people have been watching this, and I've certainly just anecdotally seen more coverage and interest, questions and discussion than I think for other launches in recent years. So that might be a good sign.
Yeah, certainly it is decent timing for a foray into bond volatility. There certainly is some out there these days. We've talked about what we've seen out there from the 10-year and other maturities from a vol skew perspective, of course, and that seems to be a similar story going on in that neck of the woods as well. Looking here, listeners, at the old skew chart for the 10-year options, and as you might imagine, there is still yet a pronounced bid to the call wing out there, kind of a market inverse from what we're seeing out there in oil land. The nearer term maturities are relatively flat, but you get a little bit longer term and they start to get a pronounced bid to the upside. So we'll see if the people out there playing in 10-year options turn to this VIX. It's only a future right now. We'll see when the options are launched if they turn to those as a bit of a hedging mechanism or speculative mechanism. Either way, the rates and the Treasury complex is certainly more active from a vol perspective than they have been in quite some time. So if you're ever going to launch a product that dives into that space, then this is probably the time for that. Since we talked a lot about broad volatility, let's get into it now, Jared. Let's dive into the product that I know is top of mind for you right now, and top of mind certainly for a lot of our listeners this week. You mentioned at the top of the show, it is indeed crude. Crude just taking it on the chin these days. There's no other way to really put it. We talked very recently, kind of like you, had a similar sentiment to you there, Jared, on our Futures Options Roundtable program a few weeks back. A lot of us talking even then about the crude skew. We've, of course, talked about on this show many times how if you just took the crude oil volatility skew for the options and just put it up on the wall and removed all the legend and graph paraphernalia from it and just said, what is that? You'd think it was an equity option volatility skew. It is so pronounced to the bid to the downside, and that is certainly what's going on out there these days. And we talked about that a few weeks ago, like I said, on our Futures Options Roundtable program. A lot of us agreed that this premium to the puts may be a bit overdone because a lot of the move at the time, I believe, oil crude was vacillating around the low 80s, and we thought, it seemed like a lot of the bearish sentiment had been played out. Certainly a lot of the concern had been played out, and it didn't seem like there was much potential for a super sharp move well south of the 75 handle, like a lot of the puts were pricing in at the time. And boy, were we wrong. That there certainly is a lot of impetus, a lot of inertia, a lot of weight continuing to move crude to the downside. Like you kind of alluded to, Jared, a lot of hand-wringing over what the hell is actually going on out there. A lot of people were speculating when the Saudis kind of said, hey, we'll support it at 70. They put a big bullseye on the 70 strike, and at that point, people are just going to feel free to crush it all the way down to 70, and that may be indeed what we're seeing play out in the marketplace. There could be other macro factors weighing in as well, but it has been a very, very weird week or so from a crude volatility perspective. You look at the very near term of the skew chart here, the options that are expiring in a few days, and it's pretty much a straight up and down graph at this point. There couldn't be any more juice to those puts if you wanted them to. You get a little bit farther out, it gets a little bit more sane, a little bit more reasonable, but we're still talking a pronounced premium to a lot of these puts where, a lot of your at-the-money vols are trading in the mid to high 20 range from an implied perspective, and looking at some of these downside puts getting bids well into the mid 30s, if not beyond, in terms of net premium to the put wing out there. So there is still a lot of juice to the downside, still a lot of concern to the downside, even though we are pretty much at the downside, at least in a lot of people's minds, trading in the 70, mid 70 handle right now. So this is an interesting one, and I'll be curious to hear your wild and reckless speculation as to what the heck is actually going on out there in crude land these days, Jared.
Yeah, so I think one of the initial responses that people have to these sudden shifts is a very familiar kind of move in the underlying reaction in the vol level, and then the expectation, especially for people who are active primarily in equities, is that you're going to have a big reaction, maybe even an overreaction, and then some kind of a normalization in the underlying and in volatility following on that. What's different about this oil story is that we haven't just had this kind of big overreaction and then a kind of calm quieting down. Instead, we've seen kind of a second story, a second part to the cycle, as you alluded to this. But the assumption, I think, on the part of a lot of investors was that Saudi Arabia would act as the kind of the equivalent of the Bernanke put. But in oil, I actually wrote something this week about whether the Saudi put option had expired, and so when it seemed clearer and clearer that they weren't going to step in terms of reducing supply or reacting at the level of prices, I think that sent people into another round of concern about the downside. And I think that as well, the level at which domestic producers, American producers, and also Canadian shale producers have much lower break-even prices for oil than I think had been assumed before the story got going. As a result, there's a sense that since domestic producers could tolerate significantly lower oil prices, at least for the near term, for a little while, since Saudi Arabia seems willing to tolerate lower oil prices in order to, if they have to, in order to preserve market share, there's a sense that the fundamentals are quite more flexible, more tolerant of price movement, which means actually more possibility for downside price movement. And so I think that's why you've seen this continued bid in implied volatility. So, for example, if you compare the skew curve or just the level of implied vol at the money 3 months ago with where it is today, or where it was 2 or 3 or 4 weeks ago, all those recent prices are all relatively close together. There's been a definite phase shift or big transition to a higher overall level of implied vol in the crude oil market. To get more fine-grained than that, if we look at 10% out of the money options on the upside in crude, you're actually having a little bit more of a bid, maybe 2 or 3, 4 vol points today, in this is for WTI crude, than we saw about a month ago, which reflects slightly, at the margin, a little bit higher expectation or a little bit price neutral uncertainty. And the same thing is true in the put wing. Put options are still priced relatively expensively. So, for example, 95%, that's 5% out of the money. Downside puts in the low 30s are still pretty expensive for crude oil compared with high teens 3 months ago. But currently that's also less expensive than where they were 2 or 3 or 4 weeks ago. So you still have overall high levels of implied vol, but not as extreme as we saw before. And I think that's true in terms of the level of implied vol and also the shape of the skew curve. It's a sense that there's still quite a lot of uncertainty, and we still could see much more downside and volatility than we're used to, but it's not at the very peak extreme that we were getting, let's say, a month ago. And I think that's partly, as I say, because the fundamentals, while still very, very much up in the air, don't have the same kind of crisis feel to them. And I think the next catalyst is going to be, the OPEC meeting later in November. There's expectations that they may just stand pat, and there's certainly enough dissent within OPEC to make the cartel decide not to take any really drastic action. And if that happens, then we could see oil decline further. But I think that's definitely the next catalyst. What's interesting is that options markets, aside from being backwardated in the term structure, there doesn't seem to be quite that much forward implied vol priced in around the event like you might expect with earnings on a stock, for example. So it seems like people are already kind of taking that OPEC meeting in stride in terms of their pricing, and it's really just kind of a undifferentiated, high, uncertain kind of a situation. And until the fundamental story gets a lot clearer, I don't really expect that to change. In fact, the case for being long crude volatility here, given everything that's in play, doesn't actually seem too outrageous.
Yes, I agree with pretty much everything you said there. It is interesting to watch this unfold in the marketplace. We have had this extended, protracted downward move here in crude for some time, continuing beyond where some people initially anticipated, including myself. And so it's interesting to watch it unfold in the marketplace, the impact it is having on the term structure and the futures, the impact it's having on the volatility skew. As you mentioned, it has come off a little bit, but it is still steep. I think some people may have assumed that as it continued, it would eventually start to come off as it has spent most of its initial bearish force. And usually what happens eventually is that put wings start to come in, like we saw on that day on October 15th out in the S&P, the downward move, it kind of comes down to the puts and squeezes them out a bit. We're actually not seeing that to any large extent, except for the little bit of a sell-off you indicated there, Jared, but it hasn't certainly come off to any sort of appreciable levels where it was just not that long ago. So interesting to see that there still is obviously some fairly substantial concern of some near-term continued downside out here in crude. And you're right, I think we will see the domestic suppliers, they're going to get a good test out of this. They're going to see really what their break-evens are and how long they could sustain themselves at these levels, because I'm sure you've heard different levels, Jared. We all hear different levels. I've heard numbers bandied about, and a lot of the numbers I heard was 75. That seemed to be a level where a lot of the domestic producers below that for a sustained period, it might be problematic, and we're at those levels now. So we'll see if we remain here for a while, what happens to some of the domestic producers, what happens to that skew, what happens to that term structure, or if perhaps all this is a little bit overblown and these guys can survive here for the extended period, in which case that's a little bit of a different story. We'll have to play the wait and see game. And before we finish up that game, let's just dive really quickly, Jared. I know you pay attention to a lot of the international volatility markets out there. Anything catching your eye from the activity beyond these fine shores here in the old United States?
Yeah, there's, I think, a really interesting breakdown into a couple different groups right now in terms of equity implied volatility around the world. At the level of indexes for different countries, you can really break it out by developed markets, which are mostly quite quiet and have implied vols that are relatively low. Emerging markets, especially India, Mexico, Australia, all have options that are priced relatively expensively relative to the realized vols and the underlying indexes. China remains very expensive, as I mentioned at the top of the show. When you look at the difference between the implied vol and the options and the realized vol and the underlying index, it looks like very expensive to hedge risk in Chinese stocks. At the other extreme is Brazil, which has been extremely expensive all year as the election came closer. Now, any measure of realized vol is going to be backward-looking and include big moves that we've seen in Brazilian stocks. The forward-looking implied vol in Brazil has that event risk taken out, and as a result, it looks relatively inexpensive, although it's still nominally quite high. But really, that biggest difference is between the developed market countries, which are pretty inexpensively priced right here, and in a number of different emerging markets where the risk premiums are significantly higher.
Thank you for that, sir. Obviously, a quiet day, but still some stuff cooking over there in BGC. We can hear a lot of activity. It adds some immediacy to the show. I kind of like it, actually.
It's never a bad time to trade variance.
That's
involved,
true,
right?
That's true. It's always moving, always cooking over there in the variance markets at BGC Partners. Speaking of things moving and cooking, let's keep on rolling into my own personal favorite portion of the show. No offense to you, Jerry, but I love to hear what our listeners have to say. So let's get right to it and check into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail segment. Like the man said, this is your portion of the show where you get to take the reins and make your questions and comments and insights known to us here on the panel, as well as to all of your fellow listeners. This first question is actually well-timed. reason I was on the show last week, Jared, was because I actually had to speak at a Princeton U Chicago. They had a joint quantitative trading conference here in town. It was very interesting. I love the opportunities to go speak to kind of some of the up and coming next generation of quants and traders and see what they have on their mind and kind of give them some of the lay of the land from a trading and an overall industry perspective. And one of the things I took away from that event, that the students were very engaged. It was fantastic to see after coming on the heels of a big industry show like FIA, where people are kind of dour and sour on the industry, to see these students so bright and enthusiastic and energetic and excited about everything going on. That was a little bit of a refresher. But also, a lot of students came up to me with almost this exact same question. I wonder if this is actually one of the students writing in here. But the question, this comes from a listener. I'm not sure if it's a name or a handle, Timinc. It's all one word here. They write, "Hello, Volatility Views hosts. I appreciate your fine program, although much of it exceeds my expertise. My question involves the Black-Scholes formula." We'll forgive you on the spelling there, Mr. Timinc. He writes, "I'm a student studying quantitative finance," so maybe he was a student, "and we're learning about this formula right now. My professor stresses the value of this formula, but is it still widely used in industry? Do I need to study Black-Scholes in order to get a derivatives quant or modeling job after I graduate?" Well, great question, Mr. or perhaps Mrs. Timinc. I'll tell you kind of what I told some of the students last week, and I'll be curious to hear your opinion on this as well, Jared. But essentially, it's just kind of one of those things that, they stress a lot in the books in school. But there is some value to it. You need to learn Black-Scholes if you really want to get a job in this business, have any understanding of this business, not just for the historical value of it. Of course, it is kind of the starting point for a lot of what we consider to be the modern options industry, but also it kind of is the launching point for all of these risk metrics that we use today in this business. Things we talk about all the time, delta, gamma, theta, vega, all that comes from that Black-Scholes conversation. So if you don't understand Black-Scholes and how it works, you're going to have a hard time wrapping your head around those risk metrics that we use every day in options parlance. So is it used still widely, the pure, unadulterated Black-Scholes formula? No, it's been mitigated and changed, and there's binomial models out there, and you name it. There's a myriad of other models people are using out there. All of them derived or based somehow have their origins in Black-Scholes and then building upon it, as you usually do in any sort of scientific endeavor. You build upon the past and improve upon it. And there are different takes on how these things should be priced, but Black-Scholes kicked it all off. And of course, Black-Scholes helps us get a lot of these risk metrics we use today. So in general, you do need to understand how things work in this world. But to expect to walk onto a trading desk or a prop shop and say, "Hey, I know Black-Scholes, I can now price all of these options," it's going to be a little bit more difficult than that. You're going to have to learn whatever model they're running there and how they make their own personal tweaks to different variables to make it kind of custom for them. And once you have that handle, you can understand these things. But yes, in a nutshell, not widely used much anymore, but you still need to know it in order to really have a grasp on the old fundamentals, as they like to say. I sound like a fuddy-duddy, but I think that's true. Mr. Jared, do you agree or do you completely disagree? In which case, we'll have a nice, fun crossfire.
No, I'm, sort of unfortunately, I have to kind of agree. I think there's a point here that even someone who's not interested in a quant role, who's just an individual investor, could even appreciate, which is that the value in understanding these formulas is actually conceptual. It's understanding the relationship among the variables that really matter when it comes to the value of something, whether it's an option or anything else. Things like the time value of money and the relationship of equity that pays dividends, or an asset that has a high carrying cost, or and those are all relatively fundamental core parts of an asset. When you talk about the optionality, understanding how the strike price of a contract relates to time and uncertainty and the dynamics of the underlying asset. I mean, there's a lot of different ways to think about that relationship, and the Black-Scholes model is one way, and it's a very popular and important historically kind of a method. I still see people price futures using the Black model, and I think it's great to know those things. As you said, if someone's looking at a quantitative role, professionally, I think that they're going to go quite beyond that fairly quickly. But again, I think what's important is actually a kind of a deeper in your bones, almost intuitive at some point, understanding of how these different variables relate to one another, so that if you had to think about a change in one variable and what it would do to the price of a contract, you can start to understand in a quicker and more direct way what's driving changes in the options market.
Well said, sir. I guess no point counterpoint on this one, but because it's kind of an easy one to agree on, I think. But let's see. The next one we have is also an easy one, a little quick one here. I think this is a good one for you, Jared. This one comes from Alan Baxter. He writes, "What is the best source for data on trading activity in the volatility swaps market?" And Jared, since you do a lot of our OTC rundowns, this is a good one for you. So what are your favorite sources for data on what's going on over there in OTC from a vol perspective?
Twitter primarily. No, just kidding.
Yes, the hotbed of OTC swaps that is Twitter.
Okay, yeah. I mean, first of all, there aren't the volatility swaps aren't especially active compared to variance, which is very active. And if you wanted to get data on activity in variance swaps, the easiest way to get it is to be on a terminal. On Bloomberg, the function is called SDR, and it collects data from the DTCC, the Depository Trust Clearing Corporation, I think, is the source. Yeah, with changes in regulation have pushed people to report that centrally. So regulations have pushed everyone to report their activity, and there's more and more efforts to centralize and obviously to move a lot of the activity onto exchanges. Who knows what will happen in the future? In the meantime, the DTCC is the place to go to get that data. I'm not sure how accessible it is outside of a terminal or some other sort of professional apparatus. But I can mention as well that one thing that we do for clients at BGC, whether they're trading variance swaps themselves or not, because our equity derivatives operation is trying to become more and more integrated, we are able to look at that and report on that for clients and give a breakdown even at the daily level of interesting things that are going on for someone who might be able to benefit from that information. So we didn't plan this, and it's just something that we're able to do. And so if the listener is interested, they should definitely get in touch.
There you go. Call up Jared, and he'll walk you through it himself over there at a BGC. Unfortunately, we have to keep on walking right on into our final segment. It is time to open up the old crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball segment. This is the portion of the show where we prognosticate recklessly and indeed just wildly, and sometimes Jared even sits on the fence every now and then. And unfortunately, he's going to have to do it by himself this week. He has no counterpoint to balance his fence sitting with some wild prognostication. So, Mr. Jared, the floor is yours. Remember, your compliance officers are listening, sir.
So I have a view on volatility for the year ahead, which is that I think we shift from what's been a very, very low volatility market regime over the past year or two. And I think we're going to, upshift into something a bit higher, a bit more moderate still, but higher than where we've been. I think that's something that might not happen until the end of the first quarter, if not later. But I think there's a lot of catalysts driving us in that direction. With that said, I think for the rest of the year, I don't expect anything particularly eventful. I think that the biggest sources of risk that people have had their eye on, slow growth in Europe, transition and governance and liquidity and financial risks in China. These are all things that are really familiar that I think people have figured out how to evaluate and monitor. And while any of those could surprise to the downside, there's no reason right now to expect that. In terms of the U.S., I think the question for investors in the United States is, except for people on the very, very fringe, how bullish do you want to be as a matter of being moderately or very bullish? And that's just my own view. But the economic data has become so strong. I think demographic big picture trends are so favorable. Think back to where we were 6 months or a year ago. People were still paying very close attention to changes in the unemployment rate. We were still arguing about U6 and about labor force participation and these kinds of issues. Some of us started looking at wages and thinking in terms of wage growth back then, but that's even become mainstream now. So that the last non-farm payrolls report, people were just as ready to talk about the catalyst for wage growth as they were about unemployment. Unemployment is done. We're solid there. The question is now is how we're going to see the transition from all the gains that capital has made over the last several years to getting labor an increasing share of national income. And I think as soon as that happens, which based on forward-looking leading indicators could be as soon as the early summer or early fall next year, then the next question is, do we have a housing shortage? Can we deal with our longer-term demographic needs? And all of these things, I think, are point in a very strong bullish direction. For the economy as a whole. For markets, if interest rates rise or that share of income goes more towards labor than towards capital, then the mix of asset prices and which companies and industries benefit, that could change significantly. It might go from being a tide that lifts every equity asset boat to one that boosts them unevenly. And these are all things that I think we'll be able to talk about in the year ahead. But for the very short term, as I say, I don't see any big risks on the horizon or any kind of data points that are causes for concern in terms of the fundamental and economic picture. And as a result, I don't see any catalyst for volatility. So I think even though I'm ready to start leaning into a secular long volatility position for 2015, I think that into the end of the year, my speculative take is that being short vol is still the way to be.
Well said, sir. You put it very well, so I have nothing I could add to that, sir, besides we're running a little bit long. It's amazing. Even how just the two of us, we can just unwind an entire hour. It seems like it goes by in just a few minutes. Of course, we had a little bit of help from you guys chiming in with such great questions. Keep them coming. But before we go, let me check in one more time with Mr. Jared over there. See what's coming down the pike from him and his team over there at BGC Partners.
Thanks, Mark. Before I answer that, I want to ask you, I know that you're the host and you're a neutral party, but given that it's just the two of us today, nobody else is around, I'd like to get your take on volatility for if not the week ahead, maybe the month or quarter ahead, in terms of your own, getting your cards on the table.
You're right. I like to play the host. I don't like to bias you guys by giving my input because I don't want to sway you in one way or the other. The big cheer, you need to kind of be more of the United Nations. But you're right. It is just the two of us. And so even though I'm coming hot off the heels of my conversation on oil skew and how I got burned to the downside in oil, nevertheless, I will trundle ahead here very, very bravely for the future of volatility prognostication. I have to say that I wish I could give some sort of great, I take the other side to you, sir. I think that definitely we're going to be in an upward moving regime here in the near term. I don't see a lot that can really propel us up there. I think we're kind of in this kind of stagnant, kind of doldrums period. Of course, we have in the States here, the holidays coming down the pike. So that always has a bit of a chilling effect on the markets and on trading and indeed on volatility as well. We'll see if that comes to pass. So we really only have a short time period, a week or so, before we start getting into that time frame. So I think if anything is going to happen between now and then, we have no big data on the horizon. We really have nothing in the way of big earnings. The macro situation, there are a few events we could watch, but other than that, nothing of the big Ukrainian type crisis lurking on the horizon or the big Hong Kong crisis or things like that could really inject a explosion of vol into the marketplace. I think we're kind of where we're going to be for the foreseeable weeks to come. And I think certainly in the week to come, I'd be surprised if we didn't have another week like this where we're kind of vacillating in the VIX Cash realm from like the mid 12 handle up to the 14, maybe 15 handle on the upside. But that's kind of about it. I don't certainly see a lot of explosions to the upside or anything else that would lead me to say, hey, this is time to get size long volatility. So unfortunately, sir, I tend to agree with you, Maybe next week we'll get into a point counterpoint, much more vehement. A lot of niceness on the show today. All right, sir, we got to wrap it up. So give us your plug, sir, for what's to come from the land of BGC Partners.
Oh, this is something I think people will really like. So there's been an explosion of interest in size in inverse volatility ETPs lately, like XIV or SVXY, and in fact just open interest and shares outstanding in these products. Although they're not options, they're closely linked to volatility. So I think they're fair game here. And there's been a fair amount of speculation about whether investors are becoming too complacent once again. The volatility-linked ETP market, at least tied to the short-term S&P 500, the VIX short-term futures index, that whole universe has become net short volatility on a few sessions lately. And so I've seen a lot of speculation about whether this is a real cause for concern and that people are too complacent. And so I did a kind of a deep dive on this for a piece coming out very, very soon, probably early next week, looking at why that view is actually totally backwards, why there's not a reason for alarm, and actually the implications on the other side of what that flow means for market returns looking forward. I think it's something that a lot of people may find interesting. And in addition to that, we have some ideas, actionable ideas around that, as well as a look at some of those longer-term forward-looking volatility outlooks that I mentioned a moment ago about wages and what's to come in the year ahead. So I think there's a lot of interesting things for people in that update that's on the horizon. And so in any case, that's for clients of the company, and we're happy to take all comers.
Well said, sir. That's interesting stuff. I hadn't been following along with the flows in XIV on the products I often refer to as poor man's options. But you're right. That is interesting to see the flow metrics going on out there and what that might bear in mind for the broader macro mindset of the markets. I'll be curious to read your piece and see how you debunk that notion. Interesting stuff. And of course, on behalf of Jared and indeed myself, as well as Mark and Andrew, who couldn't make it today, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and for sending in such great questions. Keep those coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.